In this video, we're going to build your foundation by gaining a solid understanding of the core fundamentals that drive the entire bond valuation process. At the start of this course, I showed you three bonds, Alpha, Bravo, and Charlie, and asked you which one is overvalued. To be able to answer this question, we need to figure out what the fair price of each of these bonds is. Because what we have is the market price, which might not necessarily be trading at fair price. If something is overvalued, its market price is currently greater than the fair price. And if it's undervalued, then the market price is lesser than the current fair price. So how do we go about finding this fair value? Well, consider Alpha, which pays $40 in coupons every year for 5 years, and a par value of $1,000 in 5 years' time as well. So if we were to plot Alpha's timeline, here's what we'd have. You've got the coupons of $40 every year for 5 years, and then you get this par value of $1,000 at the end once the bond matures. Of course, I did give you the price in the example, but let's assume we didn't have that price. How would we go about pricing Alpha? If we think about the payoffs, in total, Alpha bond pays $1,200, comprising of $40 coupons for 5 years, which is $200, plus this $1,000 par, or $1,200. But the price can't simply be $1,200, because we can't evaluate cash flows as is. And that's because cash flows are not equal in real terms. Although the coupons are visually equal, in reality, the coupons that you get in year 1 is actually worth more than the coupon you get in year 2, which is worth more than the coupon you get in year 3, and so on and so forth until the 5th year. So this $40 that you get in year 5 is worth far less compared to the $40 that you get in year 1. And this is because money loses value over time. And this is a crucial principle, this is a crucial fact that guides our investment decisions. And I really need to make sure that you understand this concept, so I'm going to go a bit deeper and look at an example. So consider I give you two options. Option 1 is where I give you $1,000 today, right here, right now. I take out my wallet and I give you $1,000. Option 2, I take the same $1,000, I put it back into my wallet, I leave it in there for a whole year, and then I give it to you. Which one would you choose? Let's consider both. If you take $1,000 today, you could spend it or invest it and earn more money. If, on the other hand, you take $1,000 next year, then you would have lost the opportunity to earn money because you wouldn't have it for a whole year. So clearly, the $1,000 that you get today is worth more than the $1,000 you would get in a year's time, because the $1,000 you get today could be worth more because you could invest it and you could earn more. You could multiply that amount. You could grow that cash flow. If you wait for a whole year, then you're just going to get the $1,000 and it hasn't grown. But even if we ignore the growth opportunity, if you like, there's actually a much bigger problem. And to understand that problem, we're going to go over an example with bananas. Okay? Nice and simple, just fruit. Imagine that the world is a bit loony and the price of one banana is $1. So with $1,000, you could buy 1,000 bananas, obviously. If you fast forward to a year later, the price of one banana may no longer be $1. To understand that, let's look at historic inflation in the US. You've got a chart of the inflation in the US from sort of 1918 or so up until about 2012. And what you'll find is that on average, if you consider this entire data set over here, you'll find that on average, the annual inflation in the US is about 3.24%. I'm going to simplify that figure a little bit and assume that inflation is 3% rather than 3.24%. And for those of you who haven't studied economics, inflation is just a general increase in prices. So if inflation is at 3%, it means that on average, we expect prices of things to increase by 3%. So if I look at a sort of timeline over here, and we're looking at 3 time periods, today, 1 year later, and then 10 years later, this is what the price of a banana will look like. Remember, we said the price of a banana today is $1. If inflation is at 3%, then exactly 1 year later, the price of one banana would have increased by 3%, and will trade at $1.03. If this rate of 3% continues persistently every year for the next 10 years, then the price of a banana would be about $1.34 10 years later. Think back to that $1,000 that you have. With $1,000, you could buy 1,000 bananas today But a year later, you'd only be able to buy 970 bananas. And 10 years later, you'd only be able to buy 744 bananas. Why is that? Because, with $1,000, if you take 1,000 divided by 1.03, which is the price of one banana, then you'd get approximately 970. And likewise, if you take $1,000 and divide that by $1.34 per banana, you'd end up with 744 bananas. In other words, with no other risks, with no other factors apart from inflation, and inflation being at quite a low figure of 3%, you're worse off by 30 bananas in 1 year's time, and you're worse off by 256 bananas over 10 years. So hopefully it is quite very clear that money loses value over time. And in finance, and perhaps more broadly, we refer to this as the time value of money. This is the foundation, if you like, to our investment decisions. When we're evaluating investments, at the very least, we need to consider the time value of money. But the story doesn't quite end at just the time value of money, because you also become susceptible to additional risk by not taking the money today. Remember, I'm comparing option 1 and option 2 with $1,000 today versus $1,000 in a year's time. For example, I could run away. I could become insolvent, which is just another word for bankruptcy. I could die. I could change my mind. I could, just say I'm not going to give you the $1,000. On a more macro level, the world could go into a recession, as we've seen in 2007-8, or a depression. The world could face political turmoil or be hit by terrorist attacks. I could go on. The point is that there are n number of reasons why you might not get the $1,000 if you wait for a whole year. Right? But you would get it sort of today if I did indeed give it to you. And this exact same principle applies to firms and projects as well. For example, firms could become insolvent or go bankrupt. They could face leadership issues. They could make poor decisions. They could be involved in accounting scandals or fraud. And on a macro level, markets could face inflation, deflation, recession, depression, etc., changes in interest rates. These are again n number of reasons why you might not get future cash flows. And these risks are crucial, right? So we need to consider these risks when we're evaluating any investment. Now, of course, the exact same thing applies to bonds as well. But in the context of bonds, we have some bond-specific risk. For instance, default risk. That is, similar to firms, the issuer of the bond could go insolvent or bankrupt. Alternatively, they might just end up missing their payment, so they don't have enough cash. They haven't gone bankrupt, but they can't afford to pay the coupon, for example, or they can't afford to pay the par. So they've defaulted on their payment, and that could be a massive risk. Then there's rating downgrades. So if a bond is rated as AA to begin with and then is downgraded to BBB, what happens? Well, we know that BBB bonds are more risky than AAA bonds or AA bonds. And so to price that change in rating, the yield of the bond would increase, causing a decrease in the price. Then you've got this liquidity risk, which is just a fancy word for essentially saying you're in a place where you want to sell your bond, but no one wants to buy it. So there's no buyers for your bond. And then you've also got duration, which is the susceptibility of the bond to changes in interest rates. And finally, you've also got this prepayment risk, which is the risk of the bond prepaying early. And depending on the prevailing interest rate and the economic outlook, this might well be a good thing, but it's more likely to be a negative aspect. And as before, you would still have this market risk, meaning more reasons why you might not get your future cash flows. The point you need to take away from all of this is that valuing bonds requires understanding and incorporating these risks. When considering future cash flows, we need to see how much they're worth today, given the time value of money and other risks. The other risks being bond-specific risk and market risk. Now, incorporating these risks is achieved by a process that we call discounting. So we take the future cash flows and we discount them back to the present. For now, the only thing you need to know is that this is how we go about doing it. So this is the process that we use to see how much future cash flows are worth today. In the next video, we'll learn about how we go about discounting future cash flows. So the main message that you need to take away for now is that the value of a bond is based on the present value of its future cash flows. We look at what the bond is going to pay out over the next few years, and we say, well, given the time value of money, given the bond-specific risk, and given the market risk as a whole, how much are these future cash flows worth to us today, right here, right now? And whatever that figure is, that is the fair price of the bond. Like I said, in the next video, we'll understand the process of discounting and get into the nitty-gritties of it. In summary then, here's what we've learned. We learned that we can't compare cash flows of bonds as is because money loses value over time, and we call this fact the time value of money. Apart from the time value of money, we learned that we're also susceptible to other risks when investing in bonds, including bond-specific risk and the market risk. Finally, and perhaps most importantly, we learned that the value of a bond is based on the present value of its future cash flows, given the time value of money, as well as other risks. Hopefully that's made sense. If not, please rewatch this video because it is essential, it is absolutely vital for the rest of the course. That's enough from me for now. Have a go at the quiz, and I will see you in the next video.